At one, let's take a look at market news now. Most Asian stock markets shrugged off Wall Street losses and a lackluster start today, while the dollar edged up as investors priced in more US rate hikes after upbeat economic data. Japan's Nikkei rose as buyers stepped back in for bargains following 6 straight days of losses, with SoftBank gaining after a report that it plans to invest as much as $25 billion in Saudi Arabia. The Nikkei ended the day 1.4% higher. Hong Kong stocks firmed, helped by index heavyweight Tencent Holdings, which climbed to a record closing high after posting solid third-quarter results. The Hang Seng index rose by 0.6%, but mainland China's Shanghai Composite index shed 0.1%. US stocks fell yesterday as energy sector shares dropped for a fourth straight session, tracking crude oil prices. There were also concerns over the passage of a tax revamp after Republican senators were critical of the proposal. A rise in both inflation and retail sales sent a signal to the Federal Reserve, which has been concerned about a recent disinflationary trend. The S&P 500 ended the day down 0.5%. The Dow Jones Industrial Average fell by almost 0.6%, and the Nasdaq Composite Index dropped by 0.47%. Despite a negative close on US markets last night, today global markets are generally trading in the black. However, the London FTSE has experienced some weaknesses. The local currency made some gains against major currencies yesterday, but remains well above the 14.30 mark against the dollar. In commodities, the gold price has lost some ground, while Brent crude prices are trading above $61 a barrel. And in company news, finance specialist Investec has reported a 12% rise in its first half profits. Let's take a look at the indicators. Stephen Nathan, founder of 10X Investments, joins me now from our JSE studio for more on the markets. Good afternoon. Thanks so much for your time on SABC News. US markets closed down last night, but markets today appear to have shrugged that off, although I see that the London FTSE is in negative territory. So what do you see as the key drivers behind global markets?
I think it's always difficult when you're looking at the very short term because, as you say, US markets are a little bit softer, and then everyone's looking for news to explain that. But if you look at the year-to-date trends, the US market has been incredibly strong. It's at all-time highs, or very close to all-time highs. So I think that we've also seen that spill over into other markets, Asia in general, and Europe as well this year. So I wouldn't be too concerned about looking at 1 or 2 days trading, but clearly markets can't go up in a straight line for very, very long. So we should expect some kind of consolidation at these levels, but I wouldn't be overly concerned about any issues about rising interest rates. We do know that rates must rise at some point. We can't have rates close to zero forever, because that would indicate we're not going to have a growth environment. And in the long run, as long-term investors, we all need growth for companies to grow, create jobs, and generate profits and dividends.
The all-share index is also in positive territory today. Is that just a Rand hedge story?
Well, it's always difficult to tell with the JSE because although it's called the Johannesburg Stock Exchange, more than half of the stock exchange is, as you say, not related to South Africa. So obviously with Tencent doing well in Hong Kong, that's been an enormous driver of our market, and that continues to be a big driver. But it's not only Tencent. We've seen Richemont very strong this year. We've seen the mining stocks, Anglo and Glencore, also do very well, and you'd say all of those are non-South African stories. If we look at the South African stocks, their performance this year and on the day has been far more muted. So we've seen the banks, particularly ABSA and Nedbank, generating poor results. A lot of the retailers also quite poor results. So when you talk about the JSE, it really is a mixed bag depending on which components of the JSE we're talking about.
Now, on a short-term basis, to what extent will the recent happenings in Zimbabwe affect South African companies like Old Mutual, also supermarket chains like Pick n Pay and ShopRite, both from a business and a stock perspective?
Yeah, so from a business perspective, I think that outside of maybe some of the retailers, the actual exposure of these companies, you mentioned Old Mutual, and I remember when they demutualized, Zimbabwe was 10% of the whole group. Today, I doubt that it is 1% of the whole group, just because of the poor economic environment they've had for so long. So I think that for a lot of South African companies, certainly the financial services companies, the exposure is not that material. It may be more material for some of the retailers, but in general, it would be well received. I mean, if there is a change in regime and we do start to see more sensible policies in Zimbabwe which lead to growth and which lead to employment, then that would be positive, because it's creating economic prosperity or levels of economic prosperity in a market that has one of the lowest or the highest poverty rates in the world. So it isn't good if you're doing business in an environment where most people are struggling. It's very hard for you to get volumes coming through. And also for South Africa, you want strong countries on your border and not weak countries on your border. So we've had a lot of immigration or migration from Zimbabwe. So a stronger Zimbabwe would definitely be good for South Africa overall.
Now, our rand has recovered some of the losses it made in recent weeks, but it looks like it's going to struggle to dip below the $14 mark. What's your thoughts on that?
Well, the rand really, I think, is a political call at the moment. I mean, if you just look at our budget, we have a 200 billion rand budget deficit this year, which means that we have to go out and borrow 200 billion rand. The government increased its funding requirements at the latest auction, but it had to pay a lot more. It had to pay another 0.75% more to borrow money, and that may not sound like a lot, but when you multiply that over hundreds of billions of dollars, that becomes a very large amount. So we're short of rands. We're spending more than we generate. That's a bad position to be in. Our trade accounts also not looking very positive. And given the political environment and the sentiment, the global sentiment towards South Africa is very, very poor. So we can't expect much, if any, in terms of foreign direct flows. So from that kind of political macro outlook, it looks like there's a lot of reasons why money would be leaving the country. It's not clear how money would be coming into the country. And unless we reverse that, unless there is some change in confidence and unless there's some change in our financial position, it's hard to see the rand strengthening over the foreseeable future to any meaningful degree.
Okay, let's take a look at Investec interim results. First half profit is up 11.8%. £314.6 million. On the surface, that looks like that's a really good result. What are your thoughts on that stock?
Yeah, so as you say, it is measured in pounds, but if you report it in rands, I think that all of that currency gain would be wiped out. So I think it's pretty much flat or maybe even slightly down in rand terms. So on a rand basis, I don't think it's that strong. If you look at the individual divisions, the asset management side, that has been a big driver of their growth, didn't do very well. They cite that in South Africa there were lower performance fees, so that's a little bit disappointing. Their specialist bank, which is a private and corporate bank, did better this time around, and their third division is a private wealth division, which did well in the UK and was basically more or less flat in South Africa. So I think the challenge with Investec is that they are quite diversified by business line and by geography, but they haven't been able to get all divisions working well. And that has been a trend we've seen over actually quite a few years now. Probably, if you go back 10 years, Investec's earnings have not grown on a per share basis very meaningfully. They still have quite a big legacy book in Kensington, where they bought one of the credit lenders in the UK just around the time of the financial crisis, and they're still carrying over £400 million of kind of bad loans over there. So I would say that it's a pretty muted performance from Investec, and they still have a lot to do. They also have a big UK head office, so they've got something like £25 million, I think it is, in head office costs sitting there for the 6 months. So they've got quite a bloated cost infrastructure.
Stephen Nathan, founder of 10X, thanks so much for your time on SABC News. It's time for us to take a short break. I'll have more business news for you when we return. Do stay with us.